Hi, this is Joe Rabel with Invest Like a Pro. Wanted to give you a little bit more information with respect to ADX and how to identify very potentially very powerful trending moves. Um, if you look at the chart that I've posted up here, this is a monthly chart of Amgen. I wanted to give you an idea of a couple of different factors that are going to play a role in how to identify something that's getting ready to do something, I think, significant. So I've got two boxes here. There's actually a lot on this chart. I want you to ignore everything but these two boxes for now. There's two parts to this video. The first part is identifying powerful, potentially powerful trending moves. And what to look for. The second part is how to manage a position and really what trading is all about or investing is all about and how the numbers work over time. So first off, I just want to look at this big box here, this big red box, and I've encased this entire area, which is from 2000 to almost 2006. And if you notice, you made a peak in early 2000 and started to go sideways, and you created, a sideways pattern, and you eventually broke out late 2005. And it had a lot of good qualities. If I'm going and I'm looking at low ADX patterns, which I believe is sort of one of the key factors that you want to try and identify. You want to look for stocks that have been going sideways, either on a monthly or a weekly chart, and have been forming some type of a basing pattern, sideways action, consolidation. And I think one of the better ways to identify that is to look for ADX. Now, just keep in mind, I've told you this in the past, the ADX pattern, the settings that I use for ADX, I use 13 for the DI lines, and I use 8 for the ADX. It causes a lot more jagged movement and peaks and valleys in the blue line, which is the ADX line. And I like that. I want to see peaks and valleys so I can compare one valley to the next valley and see whether a stock is strengthening or losing strength based on those. But if you were to take a look at this pattern and notice as this is consolidating, you've got a lot of overlapping price action where you're just going sideways. Nothing's really happening. The ADX line is dropping, and it finally drops underneath this 25 line. I've got a black or gray 25 level. To me, that's a very, very key level. And I'm trying to identify stocks on an ADX basis that have both the DI lines and the blue line, the ADX line, all below this gray 25 line. And I'd like it to be for a pretty long period of time. It doesn't really matter the time frame. I want it to be anywhere from 25 to 50 bars where all of those lines are, all three of those lines are below. That's usually where you're going to get the most powerful potential setups. So as you can see, that happened during this period, and it also happened during this period here. So I've highlighted these two boxes. The component that is interesting to me that I think a lot of people overlook is if you're looking at ADX only and you're not looking at price action, you wouldn't notice the difference in the depth. Look at how wide and loose this base was. Deep pullbacks, big rallies, big pullbacks, a lot of movement taking place in what is considered to be a basing pattern and has developed a very nice looking ADX setup because these three lines remain below the 25 level for a very long time. If I'm just looking at ADX, I'm getting really interested if it breaks out. However, if you were to look at this from a price action standpoint and realize that this base is missing what I consider to be my component, what I would call is compression. This pattern here, the box here, look at the difference between the highs and lows. And this is pretty significant. I would say from 80 down to 38. And this one is right around 62 down to about 45. It's half the size in terms of depth. There's not the same type of wide and loose price action that is taking place here. This type of price action doesn't mean you can get a lot of strong moves coming out of these, and you can get follow through periodically. But if you're going to get a false breakout pattern out of a long, low ADX pattern, it's going to develop because you have big, wide, and loose action. It's going to be very rare to get a false move when you get a breakout and a strong breakout out of a tight compression pattern like this. So price action, as I've said in other videos, is the most important thing. I think if you can look at price and see the width of the drops and the fact that you're not wide and loose, and in fact, you're very quiet and tight during this consolidation pattern, during this box, whereas in this box, the movement has big, wide bars, long tails, big movement, both jagged up and down, and it goes a big, huge way to break out. I just think you're going to be better off if you're focusing, looking for names that have this type of action, which is much tighter. I think you're going to see more explosive moves. But if I'm looking at this and I'm saying, you know what, this has most of the things I like to look for. The ADX pattern is great. I'm breaking out of a 4 or 5 year base. I mean, these are very important concepts. I might go down to a weekly chart in this instance. In fact, I definitely would go down to a weekly chart in this instance to, maybe identify a little bit better entry. But even if I did that, I think I'm going to get in this and end up getting stopped out. So I just wanted to point out that I'm going to show two different trades during this whole chart. And I'm going to show how over time, this is what it's going to take to make money. Okay, so I'm going to move this over here. And we're going to take a look at the second part of this video, which is related more towards risk management, but just giving you a better understanding of what it really takes to make money over time in the market. So I'm going to assume I've got an $100,000 account. The risk parameters that I use would be a 1% risk per trade, which comes out to be $1,000 on the $100,000 account. Also, because these trades are pretty significant on a monthly chart, and even if I do it on a weekly chart, a lot of times I think right around the 10% is not a bad level to start with. It probably sounds like a lot if you're a trader, and it sounds like a little like too small if you're a longer term investor. But a lot of these types of patterns, especially if they're breakout patterns, they should follow through. They shouldn't give back a huge amount right at the beginning. And so I think it's a pretty good spot to start with. So if I'm using a 10% risk and I want to do use a $100,000 account risking 1%, my allocation is basic. I'm going to risk $10,000 per trade, meaning I'm going to invest $10,000 per trade and give it 10%. So in this trade here, I'm going to assume this trade, I'm going to take this trade based on how good the ADX looked, the fact that he'd gone sideways for a very long time. I'm just going to discard the fact that it didn't have compression just for the sake of argument, because I want you to see how this works over time. So let's say I buy this at $80. I'm going to risk 10%, which would be about $8 on that stock. And if it drops down to, say, I guess it would be around 72, then I'd be stopped out and I would take my $1,000 loss. And that's exactly what took place in this trade. If you were in it, you would have been stopped out. It was a failed breakout, a failed new high. Just couldn't get itself going and follow through. It then spent a long time going through consolidation. So it was really the right thing to do to get out of the way of this, because it could have gotten a lot worse. If you bought it at 80, it dropped down to 40. So, just buying and holding and hoping is not really the way to make money over time. I mean, you would have sat in this for 4 or 5 years before you saw any kind of retracement back towards where you entered. So the second trade, which we already discussed, is, I think, setting up a much more powerful setup. You've got a tighter pattern. It's got the compression look. It's got really good ADX as well. So I've kind of got all the conditions in place. So, I'm going to do the same parameters in this trade. I'm going to risk $1,000. I'm going to put up 10,000 in this trade. I'd probably be in right around 68, somewhere in there. I might be buying, on $10,000 worth, I might be buying like 150 shares or something. And what I'm going to do here, I'm going to have my stop in place 10% below, and I'm going to have my $1,000 of risk out there. And then as just a way to show you how you can manage risk as well as manage a winning trade, I think in a consistent manner. This is just an example. I mean, there's a lot of different ways to do it, but one way that I've done it over time that's been successful is you basically, once you get what you risk. So if I risk 10% and I'm up 10%, that would be target one here. I've already drawn the lines in. At 10% up, I'm going to take 25% of what I bought and sell it. So my first target, I'm basically going to make $250 because I'm up 1,000. I risked 1,000. I'm up 1,000, and I'm going to take a quarter of that. That leaves 3/4 of my original position to try and profit and make more money. Now, once I'm up 20%, which is 2 times what I risk, I'm going to take another quarter, and that's my second target. So I'm going to make $500 on that piece. And then if I get to 3 times, that's target 3. That's another 10%. I'm going to take $750 profit, and I'm going to leave my last quarter. The last quarter, instead of taking a fourth target, a T4 here, up 4 times or 40%, I'm just going to keep trailing off this 18-month moving average, and until that line is broken. And I usually give it a little bit of room. I don't want to put it right a penny underneath. It's a long-term line, so you give it. I've given it some room underneath. In this case, I think you get stopped at around 142 or something like that. But because you trailed instead of just taking a target, it gave you the ability to have a much bigger win. So on the fourth target, you actually make $2,250. So when you add all this up, your total profit is $3,750 on an original investment of $10,000 and an original risk of $1,000. Now, I've done 2 trades. The first trade, I lost 1,000, and the second trade, I made $3,750. If you think about it, I could have taken another loss. Say there was another trade that looked something like this, and maybe I lost money in that one, lost another $1,000 in that trade. I'd still be way, way ahead, because what I've done on my winning trade is I've managed it in a way that takes the risk out pretty quickly. Because if you think about it, if I take this first target and I take a quarter off and I'm trailing off the 18, by the time this hits that first target, I'm starting to move up. Once I get to the second target, I'm basically at a break even. I really am at a break even. In fact, the worst I'll do is probably make a little bit of money. Because if I get stopped out at the 18 on the balance, I'm still going to have made a couple of targets, and that's going to make up the difference in whatever I give back. So I thought this was just a really good example of how, number one, what to identify in the type of patterns that you want to play, and just giving you a better understanding that over time, you're going to have big wins that are mixed in, because what you're going to end up doing is you're going to take losses. You're going to take some that just hit T1 and reverse down and stop you out, and you take a small loss. Some that go to T2 and you take a small profit before they turn down. And then others might hit 3 targets and you make a little bit, you make a decent profit, but nothing great. And then so you're taking small wins and small losses, and then all of a sudden you catch one that just keeps trending. And I think if you identify the low ADX pattern, the compression plays, the ones that have the nice long basing patterns in place before they get moving, you have a much higher probability of catching these bigger wins. So anyway, that's kind of the 2-part series. I hope this was helpful, and we'll talk to you soon.